This podcast is about the FASB's project to make targeted improvements to the accounting guidance for financial instruments with characteristics of both liabilities and equity. My name is Damon Romano, and I'm a senior manager in DPP. Before we dive headfirst, here's a little interesting background information on this subject. The FASB added simplifying the accounting for instruments with characteristics of both equity and liabilities to their agenda back in 2004. In 2010, the board acknowledged that they did not have the capacity to devote the time necessary to work on the matter, and the project became inactive. However, in the interim, U.S. stakeholders continued to express support for a project on distinguishing liabilities from equity. That being the case, late in 2014, the FASB added a project to its agenda to address targeted issues with accounting for instruments with characteristics of both liabilities and equity. So let's discuss where things are at the time of this recording. The current scope of this project is to make targeted improvements to the accounting guidance for the classification of certain instruments as a liability or equity. In the center of the slide, you see the three items that currently fall within the scope of this project. First, instruments that contain down round features. These are features in an instrument that adjusts the strike price of an instrument downward. We will explore more in a moment. The other topic currently covered by this project is the indefinite deferral related to certain mandatorily redeemable instruments in the current literature. Finally, the project also covers improving the navigation within the codification. FASB has made decisions on the first two issues, down round features and the indefinite deferral for certain mandatorily redeemable instruments. The rest of this podcast is going to focus only on those two issues. As you can see at the bottom of the slide, an exposure draft is expected in the fourth quarter of 2016. Note that the improving navigation portion of the project scope is not going to be in this Q4 exposure draft. The first issue that FASB decided on is accounting for instruments with down round features. First off, what is a down round feature? A down round feature is a provision in an equity-linked financial instrument, such as a warrant or a convertible bond, that provides for a downward adjustment of the exercise price, specified contingent on certain events occurring. More on that in a moment. Under the current accounting literature, down round features generally prohibit equity classification. As a result, all warrants and certain embedded conversion options within convertible instruments that contain this feature are classified as a liability, initially recorded at its fair value, and as its fair value changes, those changes are recorded in net income. It is this accounting treatment that is causing the issue. Before we discuss what the FASB decided, let's clarify the types of instruments that are covered by this decision. The instruments that will be affected by the proposed guidance will be any financial instrument issued by an entity that gives the holder the option to buy equity shares of the issuer at a fixed price, where that fixed price would be reduced contingent either of one of the following events. Event number one would be the issuer selling its common stock for less than the initial strike price of the instrument, or two, the issuer issuing an equity-linked instrument with a strike price that is below the initial strike price of the instrument. So what did the FASB decide? They decided that for purposes of determining liability versus equity classification, to ignore any down round feature in the instrument for classification purposes. This means that the feature under the current literature that prevented equity classification will be ignored in the debt versus equity analysis. The result would be that some instruments or embedded features which are classified as liabilities and measured at fair value with changes in fair value recorded in net income today may be treated as equity or not separated from the host under the proposed guidance. When would the effect of the down round feature be recorded under the proposed guidance? That's going to be when the feature is actually triggered. Where the effect of the feature is recorded would depend on whether either authoritative guidance already addresses the accounting and or the classification of the instrument. Based on our understanding of the decisions made to date, this accounting guidance would most likely have the following impacts. More freestanding instruments with down round features, for example warrants, would be classified as equity instruments, and when a down round adjustment is triggered, special measurement rules would apply to recognize the value of that down round through equity. The second would be more embedded conversion options within debt and equity instruments. For example, convertible debt and convertible preferred stock would not be separately accounted for as a derivative, and current authoritative literature, for example, the beneficial conversion option guidance in ASC 470, would be applied when a down round adjustment is triggered. Finally, for transition, the FASB decided that entities should apply the proposed guidance to all outstanding instruments as of the effective date using the cumulative effect approach, meaning no prior period adjustments and adjustments to the opening retained earnings in the annual or interim period of adoption. So let's talk about issue number 2 now. Issue 2 and the last issue that we will discuss in this microlearning. This is about the indefinite deferral in ASC 480 regarding mandatorily redeemable instruments issued by certain non-public entities and then certain mandatorily redeemable non-controlling interest. In the current literature, the application of ASC 480 to these instruments has been indefinitely deferred. So the long story short here is that the board decided to replace this indefinite deferral with a scope exception in order to improve the codification's readability. The scope exception will be defined using the current scope of the deferral based on a non-public entity that is not an SEC registrant and the SEC registrant definition in Topic 480. All this is a fancy way of saying that the stuff that is indefinitely deferred is now scoped out of 480. That concludes this microlearning. As of this recording, as mentioned before, an exposure draft for issues 1 and 2 is expected before the end of the year. Thank you for your time and listening to this microlearning today.